Ladies and gentlemen, welcome to An Independent View with your host, Lobo Tigre. Our guest of the day is my old school chum, Egon Vorfeld. He's a money manager in Switzerland. His company, the Forum Finance Group, has about 2 billion in assets under management. And unlike many other players in Switzerland, where they've yanked the welcome mat for US persons, he is registered, or the Forum Group is registered with the SEC. And I'm not putting a plug in for Egon here. Actually, we have no business affiliation. I don't think he's ever sent a client my way or vice versa. But I'm just letting you know who he is and why it's worth talking to him. And particularly now, lots of interesting things going on the global stage, and Egon is on the other side of the pond. He's got a lot of experience looking at things from a different angle than many of us US-based people have. So I really wanted to get Egon back on the show. One more thing by way of intro. Egon is not a gold bug. He's not a metals and mining guy particularly. He's a wealth manager. And what really struck me when we hooked up again a few years back was that he actually caught the wave of the big gold bull rally back up to 2011 peak. And I thought that was really interesting for somebody who isn't a full-time gold bug. So open-minded guy, generalist investor who's also willing to go there for commodities. Egon, thank you for being on the show.
You're welcome. It's always great to talk to you.
Well, that was a pithy response. All right, so let's get right away to the views from across the pond. Over here in the US, it's so easy to get wrapped up in what the Fed is doing all the time. We just had the Fed not rock the boat yesterday, except apparently for gold. But things are looking somewhat different in Europe. The recovery rates are different. Can you give us a brief overview of your outlook for Europe and maybe contrast it a bit with that for the US and the global scenario?
Yeah, sure. I mean, I think that the really big differences are primarily that the US came out of the whole pandemic a lot quicker than we did here in Europe. And therefore, it's very interesting for us to see what is going on in the US, because it's sort of likely to probably be happening to us as well. In the way that, China probably was the first one to come out of the pandemic. And now already we're seeing growth in China coming off its highs after its sort of really quick recovery. So the question, I guess, is to what extent this similar thing is happening in the US already or not, and giving us a bit of guidance of what will be going on in Europe. So we really try and look at it from a global perspective and learn from what's been going on in the other markets. But certainly in Europe, we're still seeing the recovery happening, opening up, and the economy growth increasing, and inflation obviously coming with that. So that's the main thing in terms of the economic growth difference.
Actually, let me jump in there real quick and ask you. That's an interesting way of framing it in terms of roadmaps and examples. The jurisdictions are so different, and the Chinese lockdown was so much more draconian, and therefore one would expect the rebound to be so different. And is that really an example that's relevant? And the U.S. with the 50 laboratories of democracy approach of Texas being wildly different from New York and so on. Do these things really provide global examples?
Well, I think that you can never really assume that Europe and the US are going to behave similarly, and neither, certainly not China, as you suggest. I mean, the big benefit of China obviously is that in a sort of autocratic environment like that, when they make decisions, they're implemented the next day, and there isn't much discussion. Where Europe and US very different. Europe is similar to the US in the sense that we don't have states, but we have countries, and all these different countries have gone about their pandemic very differently as well. So, Texas may have behaved like the UK, and California may have been behaving like the Netherlands, and another states like Italy. I mean, these comparisons are obviously just an example and not really true. But I think you can I mean, I think it's more that we're conscious of the fact that the US got out overall a bit earlier and a bit quicker than Europe. And so it's interesting for us because we're comparing economic growth and we're looking at valuations, relative valuations, based on the growth and the growth prospects. And the US market is clearly more pricey, more expensive than the European market. And but that is in part explained, I think, by these differences in growth or in imminent growth.
So really quick on one point about that that's come up twice in what you said. Is it the sense, well, one within your firm, but maybe more broadly, if you can step outside yourself in Europe, is it
Sure.
the sense that the pandemic really is passing, that, the Delta variant, comes and goes, and then after that, it's all downhill for here? Or is there much fear that, the next variant could be even worse?
I think the general feeling here is that we have learned so much that of how these variants behave and how to accommodate them, and really largely thanks to the intensive vaccination programs that we are so much better prepared now. If indeed a variant, I don't know what they're going to call it, E or F, comes around, I think the fear of politicians locking everything down again has slightly gone away. Whether that's clever or not, I don't know for sure, but I think it is reasonable, I think, to expect politicians who have learned a lot, in particular of the pain and the cost of shutting down economies, that it's very unlikely they're going to go back there. I think they're clearly, whether you're for or against vaccination or not, but they're clearly pushing everyone into vaccination, and that, I think, is how they're dealing with it. Rather than shutting everything down, they're just saying, listen, if you're not vaccinated, if you're not protected, you just can't participate in life, quite frankly. They recently changed the rules here in Switzerland, as an example, that you cannot go to restaurants, you cannot attend any indoor events of any kind, unless you can show a negative test that you've just taken, or you have a vaccination certificate. So that's quite
have that here in Puerto Rico too, by the way. It's striking to be asked for your papers at the door of a restaurant. I just want to go to Burger King and I got to show a vaccination card.
Yeah, no, it's crazy. It's absolutely crazy, and I think it's quite. I think libertarians have, they're having a field day with it, obviously, because it's an unimaginable situation. I mean, I speak to people in Europe, and some of them say that they if you'd asked them 3 years ago, what is more likely to happen, that we have a war in Europe, or that governments shut us down and you have to show papers to go shopping and to go to a restaurant for a meal, I think everyone would have picked, more likely to have a war. But this is in fact a war too, I imagine, but of a different kind. No, so the economic differences are still quite clear. We're more recently, we've shifted our allocation a little bit away from the US and more towards Europe. We've actually been quite keen on the emerging markets, and that's obviously an area where we're not really seeing the results just yet, and China's thrown a real nice spanner in the works on that one as well, which we can talk about. But yeah, from a valuation perspective, and that is sort of what we look at as asset allocators, because we manage our clients' money on a global basis. We have a very open mandate. We're expected to invest worldwide. We're expected to cover many sectors. We think Europe is actually an attractive place to put your money now, because they still have that sort of growth spurt that the US has already had coming. And there's nothing like strong corporate results to drive stocks and shares.
Okay, well, and you're not the only one I've heard say that. And obviously, with the stretched valuation contrast as a potential source for investment, destination for investment dollars. But I want to ask about this sort of assumption that we get more recovery. What about the knock-on effects? I mean, it always impressed me as this gigantic shutdown. You know, people talk about it's unprecedented, uncharted waters, and then they move on. Like, okay, we've said that, and now we're just going to keep going like everything's normal. It's not normal. Nobody knows what the impact of shutting down the global economy. I mean, you mentioned libertarians. It's like John Galt turning off the motor of the world. You don't do that and just snap your fingers and everything comes back again. So I wonder about the sort of assumption that, you know, things will be hunky-dory, the recovery will keep going. And is that something that you see differently from the other side of the pond? Or are you pretty confident that, let me rephrase it. Key difference is, obviously you shut down, you open up again, there is some rebound, right? But does it go back to where it was before, or is it a lower level? And how long does that take? What's your outlook on that?
Well, I think we're a bit similar to the sort of sentiment you're expressing. We're also expecting it to take longer than some people might have suggested. And even in China, you know, we talked about China bouncing back very quickly and being able to make decisions overnight and implement them. Even they're struggling with bottlenecks to this very day. There is clearly the risk of social unrest, which is why the government, I think, has been acting in the way that it has recently, and dressing it up as a sort of, you know, good for prosperity for all. But, you know, clearly they are concerned about their people, you know, being unhappy as well. So I think there are a lot of unknown effects, as you suggest. I do that and it's going to take a lot longer, and it's also created a lot of change. And I think a lot of people have because of the lockdown and the furloughing of employees and stuff, have re-examined their life, their jobs, and will draw perhaps some pretty unexpected conclusions. So no, it's definitely had a very integral impact on society as a whole. People are now saying, I think in the UK, for instance, that you can no longer offer a job to someone without immediately proposing that they can work part-time. You know, I mean, there are really very, very fundamental changes that are taking place on the back of all this. Technological changes have been accelerated by at least 5 years. I mean, huge changes happened, and I'm sure the effects of that are still to some extent unknown to us.
But net, you are still expecting and investing accordingly based on the expectation that you see more growth in Europe, or, you know, whatever level it gets to, faster growth in Europe as it catches up to the US?
Yes, we're not expecting everything to go back to normal by the end of this year or even by next year. I think it will take longer. Some that's for the economy as a whole, and I think for some sectors, obviously, they're going to take even longer. May never come back, and some sectors have clearly come back and then gone beyond pre-pandemic, and then obviously it's still the e-commerce stuff is it's just gone ballistic.
So in that case, when the ECB talks about, you know, they're making noises now, like, oh, we're getting close, things are heating up, we might start tightening policy. Do you believe that, or is that sort of lip service?
No, we don't believe that they're going to be tightening anytime soon. I think the tapering starting next year, I think, sooner is to be expected. But that's just central banks, tapering. Central bank raising interest rates is a whole other ball game, and I think they're going to be looking primarily at wage inflation. Mm-hmm. And so far, we don't see a lot of wage inflation in the overall figures. I mean, there's a lot of anecdotal evidence of very significant wage inflation, but it seems to be in very specific pockets. And also we are only just about to come out of the all the support. I mean, the US, you've withdrawn the support months ago, whereas in Europe, that's only just about to happen. And the big question mark for me is, what is that? What's going to be the result of that? I mean, are all these employees that have been furloughed, are they going to actually be allowed back when they do hit the payroll again? And
will they find a robot's taking their job?
Yeah, well, that's a slightly longer term perspective, I think, but certainly that's inevitable. That in many areas, many jobs will no longer exist 10 years from now, and they'll be replaced by robots, and then new jobs will appear.
Let me ask it this way. There's actually, to my mind, a very striking increase in the amount of headlines and coverage in mainstream media, not just wild-eyed radicals like me, about a potential for stagflation, right? The growth numbers not coming in where they should be. You've got this rebound and then things cooling. So you've got cooling and you've got persistently high inflation. Well, gee, that sounds a lot like stagflation. Is that something of concern for you over there in Europe? And where does that leave the policymakers? Because the assumption is high inflation means high growth, and therefore we have to put the brakes on.
Yeah. No, I think stagflation is definitely on people's minds, but we've lived with a situation in Europe where inflation has never actually managed to hit its target, and the main role of a central bank in Europe is to have inflation at or about 2%, and it's I can't remember when it last was there. I mean, it's so.
Poor Mario Draghi went crazy trying to get it above 1%.
So exactly. So we're sort of looking forward to the day that we can get inflation of 2% again, because we just haven't had it for so long. And so I think they're quite willing to risk it going beyond that for a while anyway. So I guess for us, the concern of stagflation comes a little bit with also hope of inflation. So we're a little less maybe worried about it for that reason.
All right. Well, we could probably talk all day about macro. Go ahead.
We just haven't seen it for so long. That's why. So
understood. All right. I have a million more macro questions, but I want to dive in more on some of the commodities specifically. So before we move on, though, you mentioned China, and of course, there are a lot of headlines with the Evergrande thing and so on. Do you see what's happening in China as a significant and long-term change, or is this just a kerfuffle now, one more thing post-COVID-19?
Well, I think we don't know.
I respect that answer.
But there are that we don't know, but there are, because there is, although at one hand you expect logic to prevail, to recognize the incredible change that has happened in China, and the incredible benefits that has brought for it as a nation, as an economy, for its people. With a middle class that is growing hugely.
You're talking about the changes that Deng Xiaoping brought on.
I'm talking about, yes, I'm saying that now with some of these recent announcements, it almost feels like we're going back to, I mean, I'm going to the extreme, but we're going almost back to Mao type sort of measures. And there are voices in China that are saying that Xi Jinping is concerned about the middle class growing too quickly, because he will not be able to control those guys. And and the main concern for them is obviously for the party to be able to control its population. And the bigger your middle class gets, the more difficult it becomes to control them. I mean, people who are not very well educated and not living, outside of big cities, they're easier to control with that kind of apparatus. They have different expectations of life. But as the middle class, I can't remember what the numbers are, but I don't know, 200 million of them. I mean, it's probably going to go up by 50% in the next 5 or 10 years, and that means the party has a real challenge in maintaining its grip on the population. So they're going to have to tread a fine line between meeting that objective of theirs whilst not upsetting in a way the sort of miracle wonder that they've had in the last couple of decades.
All right. So assuming things don't blow up for them politically, economically, are you worried about China slowing and that engine in the world going into reverse in any way? Or do you think we've, again, moving on from the pandemic and China can be expected to keep pushing things forward?
We're actually reasonably bullish on China. We think China will continue to do well, and maybe economic growth will come down. It's effectively been coming down for a while because the larger the base number, the more difficult it is to grow at these high single-digit percentages, and Evergrande collateral or unintended consequences of that will no doubt have some negative impact on growth. I mean, there's definitely a real risk of negative impact on growth for the next year or two, but it will still be decent growth. It will still continue to grow, and it's still one of the fastest growing
lackluster growth in China is still better than most other people will.
Yes, and especially compared to Europe, So we're still very impressed with their growth rates. But we talk about China, but we really like other frontier markets, and we've done rather well investing in frontier markets for the last year or two, and that could be Kazakhstan, it could be Vietnam. I mean, even Greece and Turkey are sort of fall under that banner. So there are other areas of interest other than China as well that are going through great growth.
Well, that's interesting because I think of you as this very conservative Swiss wealth manager, and going to frontier countries sounds, kind of like an international speculator. Is that something you do with a small portion of the portfolio, the high risk end, or how do you sell that to clients?
Well, we have to sort of do away with the myth that if you want to make a small fortune, you give a big one to a Swiss banker. and we can no longer rely on old-fashioned concepts, let's call them that, for people to bring money to Switzerland and have it looked after here in Switzerland. So performance is really important, and become more and more important, and also the younger generation of clients that we look after have very different expectations. So but I guess we do pride ourselves here, the Forum Finance Group, that we go beyond the sort of obvious, and we go and look for real pockets of value, and we're very open-minded. So hence what you said about gold, we were quite willing to go quite big in gold and gold mining, and then even in small mid-size companies, including exploration companies. So we're quite willing to go and look for the deep value propositions that the global markets offer us, and frontier markets were an obvious candidate for that. And even now, our investments in that area were up 35% last year, and they're up again almost nearly the same this year, and they're still trading at less than 10 times PE numbers with growth rates of 24%. I mean, for me, then you have to get over the geopolitical issues and all of that, but you get very well compensated for those kind of risks. So it's a very interesting market, but in the same way that a very unlikely place for anyone like us perhaps to look at is uranium. One of your you know about a lot more than we do.
You're getting ahead of me. I was going to ask you about that, but sure, let's go ahead. I was struck when you told me before we started talking that you jumped on the uranium bandwagon. It makes more sense given what you've just said, but what prompted you to that specifically? I mean, gold, everybody knows about gold, and I can understand that. What prompted you to go long uranium before the rise?
Well, I'm not sure who deserves the credit. I'm just trying to think, but I think what tends to happen is that because of where we are here in the center of the world, that's what we think anyway, and you know, sitting in Switzerland means that we get hundreds and hundreds of people coming to talk to us about clever investment ideas that are around globally, right? Whereas obviously a lot of people are based in the UK are going to hear a lot about stuff in the UK. People based in France are going to hear a lot about French stuff because the domestic industry tends to be quite inward looking. Whereas in Switzerland, it's always been very global. So I think the part of the answer is that people come and talk to us about you know, all sorts of things. Because of the, you know, what we represent. I mean, it's still the largest pot of money in the world for private clients is managed out of Switzerland. So that's one, but then you have to sift through them and obviously figure out which ones you really want to look in more deeply than others. And just the uranium story that really struck us was that you know, the number of quoted mines had gone from 500, I think, to 50. The mines were shutting down because the price in the market was less than the cost of actually getting it out of the ground, and yet nuclear energy is clearly the only or one of the very few truly viable solutions to move out of fossil fuel. It's one of the very few viable options to go green. Once we got over the fact that nuclear is in fact green rather than nuclear, you know, thinking Fukushima and all of that. So I think that's the sort of dynamic we like to look at, the sort of very extreme mispricing. So it caught our attention because of that, and then we just, you know, really got into informing ourselves and finding the fund managers around the world who are true experts.
And when did this happen, Egon? When did you start buying?
I think it was. I think we've been following it for a couple of years, and I think we stepped in the middle of last year.
So before the big rise in the equities.
Yeah.
So from what I'm hearing from your explanation, it wasn't a particular genius that you knew they were going to go up, but you got in first, but you bought on the fundamentals, and then in due course, they played out.
Yeah. No, we're fortunate that we can always tell clients that we're investing with a 3 to 5 year view, rather than a 3 to 3 month, 3 day or 3 month view.
Understood. So with the, you know, the parabolic breakout here with the spot physical trust driving prices, have you done any profit taking? Are you thinking of getting out, or how do you see the uranium sector going forward?
I was actually adding today.
My uranium bug friends will love that. So
I was adding
$50
today,
uranium doesn't scare you away.
We think this is only just the beginning.
Very interesting.
Yeah. And what I found interesting as well is that obviously when we speak to our private clients, young and old, actually, I don't think a single one objected to the idea. I think actually
I hadn't thought to ask that, but that's particularly the young people. That's striking. They don't have some kind of ethical. No, that's bad.
No, and maybe we just, you know, maybe we're not a representative, but I think a lot of, I mean, certainly everyone we spoke to about it was like, yes, no, of course, nuclear power is green and you know, one of the few viable solutions. Because ESG has become more, you know, much more a topic of conversation now, you know, than it was only a year or two ago.
That's very, very interesting. I'm particularly, I'm encouraged to hear that young people see it as part of the solution there. Now, but without getting into the whole politics about whether there's a problem that needs solving, that young people see nuclear as part of the solution. Well, that's really good news. Yeah. All right. Well, let's talk about the other yellow metal then for a moment. Are you bullish now on monetary metals, gold in particular, or do you think last year's peak in August was the top for this cycle and it's downhill from here? What's your outlook on gold now?
And
don't be nice to gold bugs. Tell me what you really think.
No, well, I think I mean we're open-minded, as you know. I mean, we buy gold for two reasons. We buy it as a hedge, and then one can really discuss how effective that is or not. And we invest in gold equities when we see the dynamic again, you know, that I was telling you about earlier, where we feel that the mines are not correctly valued given the likely longer-term gold price. So I think at the moment we're probably quite neutral on it, but we've gone halfway. We've invested in gold and silver mines, but we've also actually gone a bit more into the specialty metals, which are going to benefit, we think, hugely from this green revolution, with all this electrification that is going to be taking place and all the transmission that is going to need to happen, you know, for all these electric cars. And in Europe, you know, they're expecting. I think it's even in a law. I think it's a European law.
Not just expecting, now,
requiring half of all new cars to be electric by 2030. So that's quite something. That's a lot of cars.
That's a lot of cars. A lot of copper goes in.
So they're all going to need batteries. They're all going to need to be able to charge themselves somewhere. So the demand for all the products you need, the metals you need to produce batteries, is going to go ballistic, we think. The supply can't sort of catch up. The same thing, you know, with transmission. Copper will be impacted heavily by that. So we think, again, that's a very interesting dynamic for us, because we can see the supply demand dislocation, so to speak.
All right. Okay. And I do want to ask you about other commodities, but before we move on from gold, I just have to ask you, there in Switzerland, it's famous for its refineries and vaults and things. And you mentioned you have two views, the hedge and then the stocks for capital gains. But do you have, or do you not have, any clients who, you know, they don't really see it as an investment or a speculation on higher gold prices? They just want to have gold. They want to have it in a vault somewhere. So whatever else happens, they've got that gold there. Is that still part of your world today, or is that also a thing?
Absolutely.
No, it is.
No, that's still very much part of our world, and you know, we would recommend any client to have 3 to 5% of their overall assets in gold bullion, and that's certainly our model portfolios. Even though we do everything on a tailored basis, our model portfolios would recommend a 3% gold bullion position.
Which is about 6 times the global average right now.
Yeah, no, it's you know, it used to be 0. I mean, we've had it as 0 as well, and so we stepped up. I'm trying to think of the timing, but it was possibly last year. I think we bought it about 15. I can't remember. Maybe it's 1,500 or something like that. I'll have to check my figures because we're being recorded. But because I've had 1 or 2 clients who've actually put very significant amounts in gold bullion, and only recently, and we had to explain it to their children. So the parents had decided that the money they passed on to their children was for a very large part going to be gold bullion in a safe here in Switzerland, and it was left to me to explain the logic of that to the children, because these kids, I call them kids, these young people, they're you know, they want to invest in growth stocks, they want to buy the next Amazon, they want to go on a blockchain, you know, they're really interested in all that. And the best way I put it to them is, I said, this is what we've done, not to make you rich, but to make sure you'll never be poor.
That's a great way to put it. How does that go over? Does that work?
And then, yeah, they sort of thought, okay, yeah, I'm going to get rich of all the other stuff, and but the gold's going to make sure I'm never going to be poor. So and I think that's sort of where the hedge idea. It's just, yeah, I'll explain the hedge idea in a slightly different way.
All right. Well, we've talked about,
I don't think, and I truly believe, I don't think you should buy a gold to be rich. I think if you want to get rich, you buy gold mines.
That's right. Well, that's what my mentor Doug Casey has always said. You buy and hold gold for prudence, but to speculate, that's what the gold and silver stocks for, which he calls the most volatile stocks on earth.
Yeah, yeah, and you get the phenomenal leverage, so that makes a lot of sense. Yeah.
All right. So back to the battery metals and or any other dislocation in the market. Most of my audience is interested in metals and mining. They're interested in broader things too, but mostly metals and mining. Of those other dislocations, any particular favorites in the metals? Like, there's a lot of metals in there. Some of them are more scarce than others. And
yeah, no, I don't think I'm qualified to start picking in the individual ones.
So just broadly speaking, the energy metals.
It's the metals that are used to build the batteries and to enable the electrification process happen.
Okay.
Right, it's transmission so it's
you're not a miner. I won't hold your feet to the fire. It's okay.
No, and I'm really not qualified to start talking about individual metals.
Okay.
At that granular level.
Here's a question then and you've been very generous with your time. I don't want to take too much of it more, but I did have this thought that my audience is primarily interested in metals and mining, other things too. But the question comes up fairly often of what about the rest of my portfolio? And I'm so focused as a due diligence guy on mining companies and exploration companies that in my turn, I don't feel really well qualified to answer like, okay, so what about the rest of the portfolio that's not in metals and mining stocks? Do you have a sort of a broad categories of, here's a general model portfolio for people that are, say, retired and on a fixed income, or people that are younger and looking for capital gains, or what do you tell people besides uranium and lithium and metals and mining?
Well, I think the first thing I tell them is that the traditional safe places to put your money are no longer so safe. And then I'm thinking of bonds. So, not so long ago, we could, the money you wanted to be absolutely safe, you put them in treasuries or, all sorts of government bonds. And I don't know, when was it, 10 years ago, but they became, what was it? Reward free
risk. Yes.
Yeah. and I think that is just exacerbated. I mean, that's just got worse. So it's unbelievably tough to find investments that are not volatile, safe for clients. So that's a little intro. And because of that, we think equities are still offering a relatively good risk reward opportunity for clients. We are looking at on the fixed income side, we are looking more at loans. We're looking more at emerging market debt, where you get a premium, even though the country has a fantastic balance sheet. Just because it's an emerging market, they pay a premium. So there are still interesting areas. High yield, I think, has now really got to the point where it becomes a little bit tricky. And you should not expect any more spread compression, but just a little bit of carry, which is obviously more than you get on the investment grade bonds. On the equity side, I think you just, I've always advised people to be very diversified. I think going for only the US, only Europe, or only Japan, or wherever is a little bit sort of a casino approach. So we highly recommend everyone to have a good spread. And right now we would put the emphasis more on Europe and more on Japan than we would on the US, whereas it was quite the opposite last year.
Okay, all right.
So does that answer your question a little bit?
Yeah, I mean, obviously you can spend a lot of time drilling in on any one of those areas, but just as a general overview, that was helpful for me. And I will think about that when people ask me. I can say, hey, I'm not the expert, but my friend Egon is, and he says this.
We froze for a sec. I would never present myself as an expert. No, but the other big topic obviously is whether value is finally going to start performing as well as growth, or better, even outperform growth, because we've gone through a very long period where growth has just dramatically outperformed value, and it's only recently that we've seen value sort of making a bit of a comeback, which then stopped again in around May this year. But that's another really important asset allocation decision, I think. So it's not just regional; it's also the sort of type of companies or the type of you invest in. And we think there's still a lot of value in value, because the valuations of the typical value stocks are still very, very attractive. So that's a part of the market that hasn't really moved.
Let me ask about that, because it seems like that flip-flop, or that change from growth to value back and forth, it's entirely driven by policy decisions. It's not really economic. It's what's the Fed doing. It's what's Washington doing, or what's the ECB doing. And I guess you can try to predict that. Do you feel that you can predict that, or how do you decide which way the pendulum will swing?
You mean on what the Fed's going to do?
Well, my sense is that when the party starts up again on Wall Street, when investors feel easy money, more easy money, woohoo, then that's when you see the growth stocks take off again.
Yeah.
So it's not about the economy, it's about the Fed's policy decisions, at least over here. But it's not just the US, of course, we're also thinking about Europe. So
no, I think that the attraction of growth companies comes largely on the back of the extremely low interest rates, because all of these companies are really valued on future cash flows, and if you discount them with high interest rates, their net present value today is going to be a lot lower than it would be otherwise. So I think you're right in the sense that the anticipated interest rate is a big factor in enthusiasm for these companies and the valuations for these companies.
I guess I got to say, I don't even think that maybe on Wall Street there's some valuation model, but I think there's a lot of people just piling in because it's what's hot. It's momentum chasing. It's not valuation. It's just momentum.
Yeah. Well, you've seen the whole Robin Hood impact. I think you're right, and and a lot of the people that got their checks in the post for their $2,000 or however much it was, I think they went straight onto their online banking platform and started buying whatever was out there on notice boards to be bought. So there's a lot of silly money in the market. I agree with that. But if you're pushing trillions and trillions of dollars into the financial system, it's got to go somewhere.
Yes, indeed.
And that's going to stop. That's clearly going to stop.
It occurs to me that there is a lot of criticism of these young Robin Hooders that don't know what they're doing. But on the other hand, I gotta say, if they're investing at all, and they're going to school, really, they're getting an education in investing, and maybe there will be some lumps, then maybe they've had some big wins. But compared to other things they could have done with that money, I think that's actually a pretty good use of funds, is to go out and get an education about entrepreneurship and participating in the marketplace. They certainly wouldn't get much of that at school.
Yeah.
All right.
I'm still a believer in a good, a bit of traditional education, but you're absolutely right. I think it's if they do inform themselves, it would be very positive. But one wonders if they actually inform themselves of what they're buying and why they're buying it, or whether they're just chasing.
Maybe I'm being a little more cynical. maybe I'm being a little more cynical in my praise there, Egon. I'm not saying that they're all going out and really doing due diligence and diving deep into their investments. I'm saying that the black eyes they'll get for the ones that don't work out will be educational.
Oh, that will be educational. Absolutely, absolutely. And my son can attest to that.
Awesome. Well, okay, you've been very generous with your time again. So let me leave the last word to you. I've asked a bunch of questions I had on my mind about how the view might be different on the other side of the pond. Is there anything else that you think is really important that investors in mind today?
Well, I do read your newsletters, so I sort of know most of your thoughts or thinking. But is there anything? What's the next? What do you see coming next? Where's the next opportunity? I mean, uranium we've identified.
Yes, we have.
Some people are talking about silver. I'm not 100% convinced on silver. Where do you see? Is it? I mean, is high? Are you? I don't know. Do you look at trading carbon credits or hydrogen? We look at stuff like that. I don't know. Are there other areas that are of interest to you?
There are, but you know, I'm for all that I am a speculator, I'm a pretty cautious speculator. And these carbon credits things, well, yeah, I get the logic, but again, that's based on government policy that can change like that. And it can change the rules of the game like that. It makes me nervous. So I would actually say that the next big thing, it's not a stealth, you know, nobody knows about this kind of opportunity, but the long-term opportunity I'm really excited about that I think still has a long, long way to go is actually copper. All these different stories that we're talking about, it's essential to the green revolution, whether there should be a green revolution or not. There is one, and the governments are pushing it, and it's essential to that. But it was essential before that. And the permitting of these giant copper mines gets harder every year. That not in my backyard thinking, you know, ramps up every year. And I think this is one that becomes, or what's special about it is not that nobody knows about copper, right? At over $4, obviously a lot of people are paying attention to copper. But it's different in that it's not one that easily gets solved. Like uranium, higher prices solve higher prices there pretty quickly. There's idle capacity, I mean, on a global scale. That is a very solvable problem. Uranium is not scarce. It's scarce now, but it won't be for long. Whereas copper, you know, it takes years and years and years to permit and develop, you know, these big mines that can really make a difference. It takes 10 years, assuming you've made the discovery. And we're looking at a decades-long trend. So fluctuations aside, I'm actually looking forward. This is something I'm looking to position myself more in. I want more copper in my portfolio. I already got a bunch of uranium, got a bunch of gold and silver. So the next thing, I'm actually pretty keen on silver on this basis too. You need silver for all those solar panels.
Yes, of course.
But the copper is, I won't say just the next big thing, but it is an area I'm looking to move into more.
Okay. Great. Right. Well, you've just made me even more enthusiastic about it. Great.
Well, I was trying to give you the last word, but there we go. All right. Well, thank you very much for your time. Thank you very much for sharing your views from the other side of the pond. I hope the audience finds it useful. And good luck with your investments. Let's stay in touch.
All right. Take care.
Thank you. You
Good
too.
talk. All right. Bye.
Bye. Thank you for watching this edition of In the Pit with Lobo Tigre. If you enjoyed or found value in what you just saw, and you're watching this on any sort of social media, please do hit the like button and the share link. Send this on to anybody you think might be interested. That helps us out a lot. If you're watching this on YouTube, please do hit the subscribe button as well. The number of subscribers helps us get more valuable content to you as well. On the subject of subscribing, I'll quickly say that if you're not a subscriber to our free weekly Speculators Digest, I encourage you to sign up. I promise if you do, we will not send you a flood of daily advertisements. You get one free weekly digest with original research not published anywhere else. Check it out at independentspeculator.com. Thank you and have a great day.